Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, founder and editor of The Daily Gold. And we will put a link to The Daily Gold down below this. Jordan, it's always good to follow along with the way you're looking at the markets, both technically and from a fundamental sense, and how you also look at intermarket analysis. When we had talked last week, you had warned that the first support level that you wanted to see a hold was that 1980 area, which we've now pierced through. You had mentioned 1950 with another support level, and that you were still looking at some of the moving averages, the 100-day and the 150-day. Is that still how you're seeing it, or what is your outlook technically on gold?
Yeah, well, I think the 150-day is coming up to 1900, if I remember right, in the next month or two. So that's a key level to really look at. But as far as the 50-day, 100-day, and the 150-day, right now, looking at the technical damage, I would say the 150-day is the one we have to focus on because there's enough technical damage here where it's definitely not going to bounce at the 50 or the 100-day. Those are out the window. So you have the 150-day coming into 1900, but you also have, if you look at a number of long-term moving averages, the 20-month, the 40-month, the 200-day, and if you look at a lot of things in between, they're all coming up in that 1830 to 1840 area. Give it a couple months, they'll probably be 1850 to 1860. Gold has a gap, I think, down to 1867. So I think that's a key area that, unless gold makes some really bullish reversal around 1900 and there's some, macro news that's really favorable, there's definitely the risk that it could come down and test the mid 1800s. So I think those are the levels we have to look at. And, in addition, if you look at the action in silver and the miners since this correction started, it hasn't been good, to put it mildly. So there's a lot of selling in those areas. We're clearly in a correction right now, and I think we're probably getting oversold. So on a short-term basis, we'll probably rebound at some point. But, looking at these monthly candles developing, you could probably see this correction continue for another month or two at least.
Yeah, so we may have a slow slog here in the summer. A seasonally slow period of time, the summer doldrums, the sell in May go away. June and July usually sluggish for the precious metals sector. As you mentioned, silver not doing so hot. Neither are the mining stocks. Makes sense, though, that they've kind of been leading the way down along with gold. When you look at something like silver, any levels in particular you're watching?
Silver has a confluence of support at 22. You have the 200-day there. I think the 400-day is pretty close to that. And then if you're looking at horizontal support, just going back many years, well, at least going back during this nearly 3-year-long period, 22 is definitely an important level. There's some support dating back the last 8 months or so around 21. So those are the levels that I'm looking at for silver.
When you look at something like the mining stocks and GDX, you had mentioned last week you thought 30 would be a solid support level to watch, but we're getting pretty close to that now. We're 31 and some change. What happens if 30 breaks?
Then you're probably going to test the open gap that's around 28. There's also 29 has been an important level dating back quite a few years. So if GDX were to come down to that area pretty quickly, we probably see a pretty good rebound, or otherwise maybe it rebounds from 30 before it tests 29 and that open gap potentially at 28. You also have the 200-day at 28.56 right now, and the 200-day is sloping up, which is interesting. Looking back the last couple years, you haven't had the 200-day moving average sloping up basically since the end of 2020, like the tail end. Obviously, there was already a peak in at that point, but that's one key technical difference. I'm looking at GDX, and then also with respect to the 200-day, and I'm also pulling up silver, the 200 days at 21.97. So that's a key technical thing you could say, is that the 200-day moving averages are now sloping higher. And so that tends to be a lot more meaningful. And there's still, again, GDX is at 31, the 200 days at 28.56. So there's still quite a bit of room there for GDX to fall and have a pretty good bounce. So we'll see what happens. Maybe GDX and silver, they come down to the 200-day and they have to, test it for a couple months possibly before a decent bounce. I'm just thinking out loud. But, here and now, GDX is obviously, it's starting to get pretty oversold, and there's some room down to the 200-day. So I think there's a lot of support there, from 28 to 29.
Okay, well, that's encouraging that both the 200-day moving average for silver and for GDX is sloping up, and maybe it goes down to test that level just below 22 for silver and right in the mid 28s for GDX. So we'll keep tabs on those. Is this a situation where, if you think back last year, Jordan, eventually silver bottomed first, and then the mining stocks very shortly thereafter, maybe 2 weeks later, and they led the charge higher before gold actually bottomed? Do you expect to see something similar this time, where silver and GDX do get down to those support levels and bounce first, and that maybe gold still has a little more work to do before it turns the corner? Or do you think it's a situation where we really need to see gold bottom and move higher first to drag silver and the mining stocks up with it?
I think it really depends on the macro, because if you're in a more stagflationary environment and inflation expectations are rising, which I don't think is happening right now, that's the type of environment where silver is really going to outperform gold. Or, you have gold in that 2100 level. So I think that, assuming gold breaks above 2100, which I do think happens at some point this year, obviously, then you'll see silver and the miners really outperform. And then back to the macro, if the market really starts discounting a recession, then that's the scenario where gold will outperform silver and the miners. Or in other words, silver and the miners will really underperform, because, that kind of environment is bad for the stock market. Gold holds up a lot better, but, the gold stocks and silver might get hit a little bit, depending on all these factors. So for me, it really comes down to the macro drivers. I mean, really in every case, I think it's just too, it's hard to say. We're watching this correction and, maybe silver, the miners, they start outperforming, and, it could be a bullish signal. But for me, I think in the big picture, it really comes down to the economy going into recession and the Fed having to ease policy. And so if it looks like we're heading towards that, which I think we are in the next 3, 4, 5 months, then that's going to be bullish for the entire sector. I just think we can't really read into like technical action for like a couple of days or a week when the macro is a little less certain.
Yeah, it makes sense. And right now, the macro has been clouded with this whole debt ceiling debate, which most people are pretty fatigued with. And we all know that they're eventually going to raise the debt ceiling like they have the last 80 times when this has come up. And so I think that once that is behind us, whenever they get a resolution here the next couple of weeks, people will start putting more focus on the health of the economy. We do have later this week the GDP number coming out, and we do have the PCE deflator, which is the inflation reading that the Fed likes to watch. But odds are inflation is not going to come anywhere near the 2% or below level the Fed has anytime soon. So do you think that the macro conversation, Jordan, starts shifting back over to the health of the overall economy for the second half of the year?
Probably. You'll have the perma bulls will be talking about how there's going to be a soft landing, while the perma bears will be talking about how all the data that's warning and worsening and how those are indicating the economy is going to go into recession. But yeah, I definitely think, especially if some data, like if the jobs data starts to, it has been getting a tad bit weaker in the last couple months. Jobless claims, I think, are at close to a 2-year high the last couple weeks. So I think if you see that data continue to weaken, then the fears of recession will be a big topic in the financial and economic news. But yeah, no, I agree with you. That's a good point about the debt ceiling. It's really clouding everything. And with respect to precious metals, like, I'm not sure it's been helpful, because I think, you had a lot of money come into the sector, but more specifically gold, because, you had these bank failures, and then there's, the debt ceiling on top of it. So I think, I don't want to say you had hot money come into gold, because sentiment doesn't really reflect that, but I think that helped the gold market. And those things are not that sustainable, in my opinion. What's sustainable is the economy has to go into recession, people don't want to buy stocks, or people are selling their stocks and getting concerned and, buying gold ahead of Fed easing. Like, that's the sustainable picture that will really drive precious metals much higher and into a new real bull market. Again, the bank failures that they're able to paper over for the time being and the debt ceiling stuff, it's temporary. So I think, some of that trade and that money that's rushed into gold, I think some of that is coming out as we're speaking.
Yeah, with the banking issues easing a little bit and with the debt ceiling near resolution, some of that money may be pulling back out of the market. That might be why we're seeing weakness in the sector now. But another thing we want to look at, just maybe as we wrap up here, Jordan, is how the precious metal sector is faring versus the general U.S. equity market. And the picture is pretty mixed there. Some people are still perma bulls and perma bears in the general equity. Some are expecting a new up leg where we finally break out of some of the range it's been in. Other people are worried that we're still in a bear market. We may see another leg lower. Based on the fundamentals that you're pointing out, that maybe later in the year we will start seeing more of a message about the contracting economy. How do you think the general market fares, and how does that relate to the precious metals?
Well, it's extremely important. And I think looking at the general market, I mean, you have a whole range of opinions from, again, the perma bulls are saying new bull market. They're hanging on to any little technical indicator, while the bears are looking at the economic data and they're saying this is not sustainable. They're looking at other technical data that's, could be similar from the early 2000s, or, when you had the Nifty 50 leadership in the very late 60s, I think, or around 1970. I'm kind of somewhere in between, in that I think that the positioning is really, really low with respect to being bullish on the stock market. I mean, it's hard to understand and say that, but people have they've gotten really bared up ahead of the recession, and they've been putting their money, in T-bills or whatever and getting 5%. And so if the S&P can push above 4,200, I think that can suck in some new capital, where a lot of capital allocators are saying, damn, I gotta, now I gotta buy some stocks. I don't want to miss this. I have career risk. And so I think that would obviously be negative for precious metals. You get that scenario where the stock market is able to push higher for a couple months. But if that happens alongside the economic data weakening, then in the very big picture, you could get some kind of lower high and, bearish reversal over some part of the summer. So I think that's what I'm thinking about with respect to the stock market. When you look at gold against the S&P 500, it's still in an uptrend, but it's, it tested that ratio. It tested 0.50 or 0.51. It's tested it 3 times now in the last, 13 months or so. And it's clear that that ratio is going to have to break, that resistance at 0.51 for gold to break 2100 at this point. I don't see how we're going to get a breakout in precious metals without that happening. So I would say in the very short term, I think, you could see more weakness in that ratio with respect to gold. But I mean, I like the macro setup that's coming. I just think it's only a matter of time, when the economy falls into recession, the Fed has to ease. I mean, we're already seeing inflation. Inflation expectations are coming down, and the CPI has been coming down. And so the Fed will have lots of room to cut. And at the same time, we're going into election year next year. So if you have real economic weakness, a real recession into the end, or I should say into next year, you'll also probably have more on the fiscal side. So I think, again, it comes back to, the stock market is an indicator for the economy, but, it comes back to that and the economy for gold. They get worse, we go into a recession, then precious metals are going to do really, really well. But if the recession gets delayed and, pushed out to the first quarter of next year, then precious metals are probably going to struggle here.
All right. Well, I appreciate you sharing kind of the medium-term outlook and the different scenarios or paths forward that you see in either climate, whether the stocks really do rally or where they kind of do a bull trap and get people wrong-footed. And we'll see how some of this macro data comes in. Again, as the GDP numbers come in and the PCE inflator, we'll have that to talk about next week. And we'll just keep following along during this kind of sluggish period for the sector. I wish there was more to report for folks, but Jordan, I always appreciate getting your thoughts and how you're looking at things, and we appreciate you spending some time with us here at the KE Report.
Thanks so much for having me.